Mike, I appreciate it, man. We're episode 11 of
Thanks.
Your Platform podcast. Just wanted to quickly ask you, Mike, one, thank you again for joining. What I'd like to do is quickly get your story, a little bit of, where how you jumped into what you're doing in mortgages, a little research that I did about yourself.
Yeah.
20 years plus in the industry.
Got in 2000, right in January 2006.
Yeah.
I was at Wells Fargo in 2005 and then left in 2006. In January, started with a broker shop up in Auburn, Massachusetts. Just a guy that I knew through somebody, and kind of got into it as the tail end of, that 2000, early 2000 market, took off. So I didn't really hit, those really good times in the early 2000s, which I think in the long run, nowadays, looking back, hindsight is good, because back then it was like the Wild West. It was insane. So started then, and I didn't realize it at the time, but I took a lot of things that I learned at Wells Fargo at the time, old school, sitting face to face with people, having them in the office, good communication, old school, like service mentality, and kind of took that into, my career in the mortgage business. And throughout it, from the early 2000s till now, when I was growing it, always had a lot of people that would tell me, oh, the times are changing. You can't do business that way.
Sure.
And growing up in a small town, in southeastern Connecticut, that's how people generally in this area still want to do business. And I still hear it now from people in other parts of the country. You still talk to your customers on the phone. You still meet them face to face when they want to. And, that's how we still do it around here.
Yeah, so that's good. Yeah. And I agree. With me, my job's a little bit different because it's a lot faster, I think, turnaround time, especially as, the business grows, more leads come in. So, but there's some value, at least to talk on the phone. And I know a lot of folks who just do it through email. And I agree that there's a valuable piece to, have a conversation with someone and whatnot. So quickly, a brief introduction about my show, because the Your Platform podcast, which I think you were one of the first people that I kind of talked about, hey, this is what I want to do. Are you interested in coming on? But it just kind of highlights, the people that are in my network, interesting folks that I come across, and, say, hey, what's your story? Let's talk about what's happening. And that's why I reached out to you, say, hey, what topics do you want to discuss? So we'll go through some of those things. We'll talk about a little bit current market conditions, what you're forecasting for the future. We'll talk a little bit about the renovation loans, the construction loans, and kind of take it from there, man. So, what are we seeing right now? I think interest rates right now, upper sixes, sevens, depending on credit. They've been kind of consistent at that. I think the Fed had announced that they weren't going to do any cuts, but did they make a recent cut?
Didn't make a recent cut at the most recent meeting in March. They took one cut off the table in 2024. And left three cuts possible for this year. Excuse me. They took a cut off the table for 2025.
Okay.
So mortgage rates, they're kind of unique, although they do follow, somewhat what the Fed does with their interest rate cuts. 30-year fixed mortgage rates and other fixed mortgage rates really follow the mortgage-backed securities market. Mortgage-backed securities are a type of mortgage-backed bond.
Sure.
So that's really where, the yields rates come from, the price of bonds and things like that. So what the Fed does with their federal funds rates, although it parallels it, what the Fed did during COVID is what really brought mortgage rates down there. What they were doing at that time, which they stopped doing, and now they're actually a net seller of mortgage-backed securities, is they were buying more mortgage bonds at the time during COVID than there were buyers in the market. So they were sopping up a lot of everything that the market was selling. Now there's not as many buyers in the market. And then on top of that, the Fed is still selling mortgage bonds. So that's what's kind of pushed rates up. And they've done that purposefully to kind of push mortgage rates up to try to slow down the housing market in a lot of instances, because that's what really goes into a lot of inflation is our housing.
Yeah. So I think, I came across your, and I just want to briefly touch on this because obviously you're not a realtor, but what do you think the impact of the NAR settlement is going to be towards, yourself, myself?
Yeah.
And I have a little bit of a low level understanding of what happened and how, the commissions that the seller doesn't no longer have to, or I guess on the MLS doesn't have to list the commission, correct? And right now that's how it's been done for decades. I think they said for probably about a century is how it's been. And I read your post that you put out on your blog, and I'm just interested to see how you think that impacts, realtors, mortgage people, and first time home buyers.
It depends on how you take a look at it, from what standpoint you're looking at the lawsuit. I haven't gone through and really did like a deep dive into it because it's not fully approved by the federal judge.
Right.
So there can be some changes between now and July with it. How I look at it, I think it's definitely going to have an effect. There's some gray area where people say, it's always been negotiable and you didn't have to pay a buyer's agent.
Right.
But I think most people, if you talk to them and they were involved in a transaction, always felt, that in most states, every state's different because they have different laws, that they felt that, it was kind of standard practice that you paid 5 to 6% and a portion went to the buyer's agent, portion went to the seller's agent. I'm told, and from what I've read, that, the buyer's agent commission very possibly will be negotiated up front now, and it will be set up front before an agent goes and shows you houses. So what you're paying the buyer's agent. And then how that's done, whether it's directly from the buyer or whether it does come from, the seller of the property, I don't really know exactly how that's going to work out or what exactly it's going to entail. It's definitely going to change, the real estate, careers of people, I would say, like that industry. I see it parallel to kind of what the mortgage industry went through in 2008, 2009 when Dodd-Frank came out.
Yeah.
NAR was able to lobby back then and kind of stay away from that whole consumer financial protection change. Sure. And I think now they're kind of going to be going through what we went through in the mortgage industry back then, where we make less per loan than what we did prior to what guys were making in 2005, 2006. You could see some fundamental changes. Back then, we used to get paid with a 1099. Now, all mortgage loan officers get a W-2 and a pay stub. I don't know if that will happen with the real estate market. It'd be interesting to see. Looking at it from my perspective, the government would probably love to do that because then realtors can't write off all of their mileage and expenses and things. And the government loves to find ways to tax people and take as much of their paycheck as possible. If you're looking at it from that perspective. So it'll be interesting to see, but I think you're going to see probably realtors, if they're older and they're near retirement age or they're not really serious about it and doing it full time, and being like a really, full-time agent that's focused on it and changing with the market. The agents that change with the market, whatever that entails, are going to be the ones that survive and how that shakes out.
Speaking of challenges, you've been doing this for quite a long time. What trends have you seen shift for the mortgage industry, from a technology standpoint? I know AI, I know a lot of insurance companies are investing in AI and obviously, at what capacity and what level does that impact me as the broker? I don't know yet. I know I use it to my advantage now, as opposed to being afraid of it taking my job. But what technology trends do you see shifting in your industry?
When I was out of the business in 15, 16, 17, and 18 and got back in it in 2019. And when I got back into it at that time, the big thing with the technology that was coming out was, in 5 years or 10 years, loan officers are going to be obsolete. The rocket mortgage, technology was everything. I think what we're starting to see now in the industry is technology is important in any of our industries, and taking advantage of new technologies to provide a better service to the consumer, hopefully to make things less expensive for the consumer. But in the long run, what people predicted back then was the loan officer is going to be non-existent. We're not really seeing that. What we're actually seeing is the technology isn't taking the place of the loan officer. It's taking the place of the production portion of the loan from application to closing.
So it speeds up the process a little bit.
Yeah, speeding up the process with verification of employments, verification of assets, all of those different things, and allowing, loan officer assistants, underwriters, processors to basically work on more files in a month. If a good processor used to be able to process 15 or 20 loans a month, and an underwriter could underwrite, 1 or 2 loans in a day, technology allowing them to maybe do double the amount of files, which means you need less processors, right. You need less underwriters, because the cost of producing a loan now is so expensive. Mm-hmm. Companies need to find that. It's why mortgage lenders in general, have lost money for 24 months straight. Mm. I mean, everything from, the biggest producers, wholesale producers, Rocket Mortgage, Fairway, there's lots of consolidation. And, it's expensive to originate a loan.
What goes into the production of a loan? When you say that it's expensive to produce a loan, what goes into that?
Most of it's government regulation.
Oh, got it.
From the standpoint of, what we have to keep for records, the amount of redisclosures, and, if things change, even if it's, not the fault of the loan officer, if something changes from the company side for what an attorney's charging for fees, if we under disclose it up front, we then have to eat that cost. We can't go back to the consumer. Wow. So it's always like an over disclosing, the amount of paperwork that has to go through, the amount of licenses, insurance, wow. All of those things that the federal government's regulations that they've put forth over the years to quote unquote protect the consumer, makes things more expensive. It always trickles down to the consumer.
Yeah.
So that money has to be either obtained upfront in higher fees to the consumer, or it's built into the interest rate when those loans are sold to Fannie Mae and Freddie Mac, which is where most mortgages end up. And the government charges more from a loan level price adjuster standpoint on loans for refinances and things now. So it's really the government charging the consumer more because they still control Fannie Mae and Freddie Mac.
So let's talk quickly, future forecasts. We got, we're through quarter one. We got Q2 rolling around here. It seems like market's getting a little bit, I know I'm busier than I had been in the first quarter and even Q3, Q4 last year. Let's foresee, the next 6-12 months. What's that look like for the mortgage industry? Volume wise, and then maybe even interest rate wise. You said they forecast maybe 3 cuts this year, or 2 this year, and did you say 1 next
3
year?
this year, and they took 1 off the table for 2020.
1 off the table for next year. But I've heard in the past that they said X but did something else. Yeah. So what do you think here in the next?
I think for most people now, last fall when rates really went up, and I mean they got up into the high 7s, low 8s at some points. I think that really shook people and made them kind of pause and stand still, which is why the third and fourth quarter were tough. The U.S. consumer is pretty resilient. So it's not so much when rates are where they are now, high 6s, low 7s, where they've kind of been in that range of mid 6s to mid 7s for the last 6 or 8 months. It's really it's that volatility when it goes up and down that kind of makes people pause.
Right.
Now, at least in what I'm experiencing right now, is people waited when rates first started going up in early 2022. They kind of waited and said, all right, we're going to wait it out. We're not going to build. We're not going to buy. Rates are higher. We have a 3 or a 3.5% interest rate. We're not willing to do that and sell that house and get rid of that mortgage for something in the 6.5, 7 range. And they waited as long as they could. Now on the construction and renovation side, what I see, which is probably 50% of my business or more now, people that were waiting for rates to go down, rates haven't gone down. Mm-hmm. Build costs have not gone down, or if they have, the cost of materials decreasing has been offset by an increase in labor. Mm-hmm. So it's not costing less to build a house now than it was a year or two ago. And now people are kind of settling into the fact that, all right, the economy is maybe not as great as everybody thought it was, not as bad as everybody thought it was. It's kind of in some middle ground, depending on your industry and where you're at. Yeah. And if we're going to do it, we're going to do it. Right. So now people are kind of getting off the sideline and saying, look, if I have a 3-bed, 2-bath raised ranch and I'm ready for my next step up and I'm going to build, you're not building a new house for $400,000 or $450,000. Right. It's generally a $550,000 to $800,000 in our area.
Right. What's the average per square foot right now?
That's always tough, but I would say if you own the land, you're looking at $250 to $300 a square foot. Okay. If you don't own the land and you're including that in the total, it can be $300 to $350 a square foot, depending on what you pay for the land, your finishes, the style. Right. But in that range. Yeah. Yeah.
And I ask because, and which we'll kind of jump into this here in a little bit, but from an insurance standpoint, people come to me, well, my loan is X, right? It's $350. Why is my replacement cost $450 or whatever the case would be? And I try to use that calculation anywhere between $250 to $300, depending on the location. You go into like Greenwich, you're looking at like $650 per square foot, which is kind of crazy. I haven't even marketed myself down that way. But when you've been in mortgages for a while, renovation loans, construction loans, has that been your niche since you came in? And if not, what made you go into that,
No, it hasn't. It has been probably the last 4 or 5 years. When I got back in the business in 2019, I was just doing your standard, purchase, refinance, conventional FHA, VA, USDA, that type of stuff. Mm-hmm. When I left and when I started at Eastern Connecticut Savings Bank, it's really when I started to try to differentiate myself because those were programs they had. Right. But even before that, it was something that I looked to. And when I went to Eastern, that was part of the reason why I chose Eastern. Sure. Is I wanted to get into doing more construction and renovation lending. My dad was in construction growing up. My grandfathers were builders, developers. So it's always been something that I've done. And, that was part of it. I enjoy that side of it. And I've always done stuff like that growing up. But I also wanted to do it because if 90% of the industry, just like insurance, if 90% of the industry is only concentrating on that standard, conventional VA, USDA stuff, if I can form a niche in an area that's needed in the area where I live and work, then I can separate myself from kind of the herd and really focus on doing that. Now, I still do those regular type of loans. It's probably 50% of my business is that. Yeah. And then construction and renovations, the other 50%, I would say. And I do a lot of portfolio lending too, which is outside the box stuff.
Leading me right into the next few things I want to talk about. So I had to do I had never heard about portfolio lending. Mm-hmm. I actually sat in on a seminar earlier this week about 203K loans and rehab loans because I knew I was going to sit here with you. Yep. So I wanted to educate myself on that. And I know it in a sense because I know, we talked about it before we started the show, certain companies will do insurance companies will say, hey, I'll take on this risk the same way as a normal homeowner's insurance policy with the endorsement. Others will do a builder's risk policy, and then you have to switch it over. So I know from that perspective a little bit. What's the difference between the two? So you got the construction loans and the renovation loans.
So the big thing with construction and renovation is the overall process and length of the loan transaction. So if you don't have the after close portion, the draw department, the construction team, all of those things that take place as part of the loan, the loan process when you're doing a renovation, a construction loan, there's a lot of money that goes into that. You have to have people that are handling the inspections, the draw reports, the updates to title that need to be done as money's drawn out and the build process goes on or the renovation process goes on. So not all companies invest in that. The other reason why a lot of companies don't do it is it's higher risk. Yeah. So when a company like OneTrust, where I am now, or when I was at Eastern, when you're doing a construction loan, even if it's a conventional construction loan, that loan can't be sold to Fannie Mae or Freddie Mac generally until the construction period is done and the house has a CO. So during that, 12 months of construction, when a house is half built, it's when a house has the highest amount of liability and risk, from an insurance standpoint. I tell people all the time, you have to have an insurance policy, because if you build a house and halfway through the build, it gets struck by lightning, like you're responsible for it. The builder, it's not his responsibility. He's responsible for liability. So when those things come up, it's why a lot of lenders don't go into that space. So there's a longer process. Generally when I'm working with somebody on the construction side, it's not a 30, 60 or 90 day process. Like when I'm dealing with a pre-approval on somebody that's buying a house, it's a, 6-month minimum, maybe 12-month
to complete the entire home. And
I mean, some people I'm working with them 6 to 12 months before the loan even goes into process. Like if they're talking to a builder, they got to get pre-approved, but they don't know what their, maximum amount that they can build a house for. And then there's the planning process, the design, the permitting, all of those different things just make for a much longer, overall transaction. So it's not as quick as the other standard, type of industry where it's, 30 to 60 days, you're done, you move on. Transactional. Building tends to be more of a relationship, that needs to be built up throughout the process.
You probably get some impatient people, I would assume, or
I think, people definitely want to, get the house built, but you also generally are dealing with people that understand the expectations when they're talking to a builder. You're not building a house in 30 days. So because that build process is longer, they tend to be a little bit more patient with it, at least in the beginning. And then during the build process, they generally want to get it done because they want to get moved into the new house.
One of the things I wanted to ask you, so what would you say the pros and cons are for the renovation and then the construction loans, if any?
Renovation is, it depends. Like I do renovation loans for people that, own the house already. So the tricky part with that is living in a house while you're doing renovations, which can always be tough. I'm starting to do, I wouldn't say starting to do, but have been doing more large scale renovations. So not so much the, somebody's looking to buy something and it doesn't pass FHA or VA or USDA guidelines or conventional, and they need to do some of those things to make the house meet the guidelines. Maybe like a smaller renovation. I've generally the last few years been doing more large scale renovations. So somebody has a ranch and they want to put a second story on it, turn it into a colonial. So larger renovations. So those can be a little bit trickier.
Or put stairs in the basement.
Something like that. Yeah, exactly. And then I would say with the construction, the new construction side, people's expectations of really what it takes to build a house nowadays and the expense of it. The pros, you get exactly what you want. Everything's brand new. You have a lower insurance cost. I see people build a $700,000 house now and their insurance premium is less than a $300,000 house that's 100%. 60 or 70 years old. 100%. So getting everything that you want and having everything brand new, energy efficient, all of those are important, but you're paying for it. I'd say the average new build now in this area is $650, $700, $750.
And for a new build, right? So I go out, hey, Mike, I want to build a house. We get the mortgage squared away. Do we have to convert that mortgage to a different mortgage after, or is that the mortgage? If the loan is $600,000 to build, do I have to do anything afterwards to convert it, anything, or no?
So there's two different types of options with that. You have a single close, which is basically whether you own the land or you're buying the land, and then you're securing the construction contract with your builder to that property, whether you're buying it or you already own it. You can do a single close, which means there's a single closing up front. And when the house is built, the CO is issued, it automatically converts to a 30-year fixed. At current interest rates, although generally people like that because you're only paying one closing, I always tell people, whether you're buying or building right now, where rates are and where they've been for the last 6-8 months or so, and where they're going to be for probably the next 3 to 6 months or roughly, the likelihood that you're going to keep the interest rate you have right now, whatever you do, is highly unlikely.
Right.
You're probably going to refinance it in the next 12 to 24 months or longer to get a lower interest rate, lower term when rates go down. So although people gravitate towards that, the portfolio, which is just a 12-month only construction loan that I've been doing a lot.
Is this a portfolio loan that you're saying, or
single close?
Okay.
Single close is something that's just a Fannie Mae, Freddie Mac, type of loan. When it's a portfolio loan, it's something that can't be sold to Fannie Mae or Freddie Mac, and we use our own. If you're a bank and you do portfolio lending, you're using depositors' money. Like when I was at Eastern, checking, savings, deposits, and lending that money back out. Here, it's similar but a little bit different. We use warehouse lines and things like that, and one of those type of loans is useful for a lot of people because we can do it in conjunction with the house that they own. So they can do bridge loans. We can cross collateralize it against the property they own and the land that they own. So it allows them to use the equity in their house that they have without selling the house, with the idea being that when that house is built, the new house, and they sell their old house, they take the proceeds from that sale, they apply it towards the loan on the new house they built, and then refinance that into a 30-year fixed or something like that. So they're kind of using the equity to best serve them.
Nice. What's the type of client for going into the portfolio lending? Is because, again, from my research that I thought I understood, it's kind of like a non-traditional loan, right? And it's maybe a 1099 employee who can't get the funding from a conventional lender. Who's your market for that when it comes to that type of lending? And what do they normally buy? Would they buy like a normal house as well?
So I can do portfolio lending like that, and I would say portfolio lending encompasses bank statement programs, self-employed borrowers, DSCR, which is debt service coverage ratio on investment properties. Anything where the income is derived outside of a W-2 pay stub tax return, which is what the government, says is the standard they set for a qualified mortgage to fit into that category. And if it doesn't fit into that, that's kind of where it goes into the portfolio, or it can go into a portfolio program. And so those are some of the people. The other people are if there's any type of a debt to income ratio issue. So maybe you have a two-person household, and for whatever reason, one of the spouses doesn't have their income on the books. They're self-employed, or their credit score isn't high enough to be able to be on the mortgage to count their income, and you have to take that person off. Let's say you have, I have some people I do them for now. If they are getting retirement income, they just retired, they haven't started collecting a pension, haven't started collecting Social Security or anything. So they have no usable gross monthly income. They can, with the portfolio, with that 12-month only construction loan, because it's considered by the government to be short-term financing, 12 months or less, I don't need to do the same debt to income ratio calculations as a regular mortgage.
Nice.
So we still want to know in the long run, what's that person going to do when the house is built? Right. But I do a lot of them now where somebody has a house that's worth $700,000-$800,000. They have no mortgage on it. They want to downsize and build a $500,000 house, but they don't have any usable income. We can give them a 12-month interest only construction loan on their house that they have now. Not have to do those same standard qualifications. When they build their new house and they sell their old one, they just pay the mortgage off, and they're mortgage free on their new house. Right. Awesome. So that's one of the instances that works.
Good stuff. We have a few minutes left here. Why one trust home loans?
It was when I was leaving the place I was at previous. I was looking to get back to what I had when I was at Eastern. So a couple of reasons I moved to One Trust. The person that I worked with that ran the residential mortgage department at Eastern joined One Trust, and he works now as my manager again. So I got to work back with him, which is obviously was
a good relationship.
I learned so much from him over the last 4 or 5 years that we've worked together. A great guy and super knowledgeable. He's been doing mortgages for 45 years or so. And then it was the perfect mix for, the type of business that I want to do when I was at Eastern, which was a mix of portfolio and construction and renovation and regular portfolio lending. And then, your standard conventional FHA, VA, USDA. So that combination is very rare in the individual mortgage banking company space.
Yep.
When you're talking about, some of the biggest 25 or 50 retail lenders, most of them don't do anything with portfolio.
Yeah.
Or if they do, it's always done through third-party wholesalers.
Sure.
Here, we do it all in-house, and we service the loans.
That was going to be my next question. Do you guys do it in-house, and do you guys service it? Awesome. Mike, where can people find you?
You can call me on my cell phone. I'm available nights and weekends, 7 days a week. To anybody that I work with. My cell number is 860-884-2103. And you can also email me, mmish@onetrusthomeloans.com.
Awesome, Mike. Thanks, man. I really appreciate you coming out and doing this for me. We got to do it again.
Absolutely.
I like telling the folks that I do this with, hey, we do it again. We'll do a pulse check, a State of the Union type call or show, and we'll go from there. So, Mike, I appreciate it, man.
All right. Thanks, Paul.
Take care. Yep. Thanks.
Have a great day.